Welcome to Capital Considerations. I'm Tony Roth, Chief Investment Officer for Wilmington Trust. Recently, Chief Economist Luke Tilley, Head of Investment Strategy, Meghan Shue, and I spoke with Denise Monahan, Market Leader for Pennsylvania and Southern New Jersey. We shared our 2025 capital markets forecast, investing in a Chutes Ladders Economy, gaming app portfolios in 2025, which covers my team's economic and investment outlook for the year ahead. During our discussion, we shared our baseline expectations for the economy and markets. We took a look at the principal upside and downside risks, which we likened to the chutes and ladders you would encounter when playing the board game. Finally, we explained what it means for our investment strategy. I hope you find this discussion useful. You can learn more about our 2025 capital markets forecast at wilmingtontrust.com.
Good afternoon, everyone. My name is Denise Monahan, and I am the market leader for Wilmington Trust in Pennsylvania and Southern New Jersey. And I'm very pleased today to serve as your moderator as we present our 2025 capital markets forecast. Before we begin, I would like to take a moment to recognize our colleagues and clients that are on with us today from California. We want you to know that our hearts and our prayers are with you in this unthinkable tragedy. Stay strong and know that we're with you. Now, Tony, may I have a drum roll, please?
Absolutely.
All right. As we unveil our formal theme for this year, investing in a chutes and ladder economy, gaming out portfolios in 2025. As always with these presentations, we have two simple goals. One is to provide a creative theme, and second, to provide the best roadmap for all of you as you navigate your portfolios in the coming year. To do that, I have the honor of being joined by my Wilmington Trust colleagues, many of which are known to you. But starting on my left, our Chief Investment Officer, Tony Roth, our Head of Investment Strategy, Meghan Shue, and our Chief Economist, Luke Tilley. So with that, Tony, if I may, can we start with you?
Please.
So as a kid, like you and probably like many others on this call today, we all played the game Chutes and Ladders. But to be very honest, I never played the game thinking about what it meant for the economy and the markets until today. So I thought it might be a great starting point for you to share some context about how did we come up with this theme and how it will influence our presentation today.
All right, great. Well, thanks so much. And it's really a pleasure to be here, as I am every year with my two colleagues to my left, Luke and Meghan. It's a privilege to be with you guys and to talk about the work that we've done and our outlook, which we're all very proud of. What we do every year is we talk a lot through the summer on what our forecast is going to be. And then we put pen to paper. And our approach typically involves is understanding what our baseline views are, given the organic trajectory of the economy. And then we think about what are the various factors, given the new year, that could deflect that trajectory, that could be the major dynamics that could impact how the economy evolves. And we've talked in past years around, for example, the industrialization of the economy from a technology standpoint. We've talked about inflation. We've talked about the pandemic in recent years. And so in this year, we really couldn't do too much, although I didn't stop Meghan from writing a draft over the summer. But we really couldn't do too much until we knew who won the election and how the potential policy discontinuity, which in fact is a good characterization, I think, of the environment, would impact the economy. So we come into the year with a baseline view of a little bit of economic deceleration, which Luke is going to talk more about a 1.8% forecast for growth. And we have, as I mentioned, this policy discontinuity, a very different approach to managing the country and the economy. And there's always a difference between what a candidate says and what they as a candidate and what they do as an elected official. And so when we have a candidate like the current president who talks about a lot of things that have never been tried before, like 100% tariffs on certain countries, deporting millions of illegal immigrants, and deregulation. He's already enacted some pretty, I think, pretty big executive orders around how the government is managed in Washington. There are two levels of uncertainty. One is what will the elected official do that may be different from the candidate? And number two, in the case where these policies have never been actually tried before, to the degree that they're being talked about, how will they actually impact the economy? And so when we were confronting that level of uncertainty, we said, gee, this is going to be really hard to write this forecast, even after we knew who won the election. And it evokes the idea of this game where you roll the dice and you land on a square, and the game has sort of a intrinsic positive feeling to it because you're moving up, just as our baseline forecast is that we're moving up, but you don't know what square you're going to land on. And you could land on a ladder. A ladder could be, for example, incentives for companies to invest in more infrastructure. A ladder could be deregulation, or you can land on a chute, which could be big tariffs, the impacts of immigration. That evocation gave us the idea of the title, or the wrapper, if you will, or what we're going to unpack in the forecast this year.
Great. And I think it's fair to say there is a lot to unpack. And so, Meghan, if I may just turn to you and just remind our audience of our theme from last year, which was all about U.S. exceptionalism. Maybe just share a few comments on how that played out in 2024 and really how that sets the stage for 2025.
Yeah, absolutely. So, Denise, as you said, our theme from last year was U.S. economic exceptionalism. Can the reign continue? And we observed that for many, many years, not only had the U.S. economy outperformed peers, but also the U.S. equity market had delivered a multi-year run of dominance. And our expectation was that this would continue, probably of lesser magnitude. And it definitely panned out. On the economic side, what we saw was that the U.S. economy vastly outperformed, especially international developed economies, but also expectations for U.S. economic growth. The U.S. economy, as Luke will talk about, greatly surpassed expectations driven by a strong consumer. And what we saw was that translated into very strong returns from the equity market. What we're showing here are calendar year returns for a variety of asset classes. And you can see that the S&P 500 delivered 25% returns, the second year in a row of back-to-back more than 20% returns. The only time that we've seen that was the tech bubble. And we saw U.S. markets greatly outperform peers, where international developed, emerging markets, they were up 4 to 7%. So a significant performance advantage from the U.S. markets. And I would say last year was sort of divided into three segments. The first segment was really all about AI. And you can see the performance of the Magnificent Seven on the far left bar there, where those tech-related companies delivered stellar performance that drove the market. But then the middle third of the year was really about broadening and expectations for rate cuts, and that performance really spread out to other cyclical sectors, banks, industrials, and other companies that are not as directly tech related. And then sort of the last punch for the year was really the post-election rally and an expectation that U.S. markets would outperform on some of the growth-driven policies of the Trump administration.
Great. So speaking of exceptionalism, I'm about to get back on my ladder. Tony, can you share of the ladders, what do you think is the most critical one for investors?
The most important one is I want to stay within the realm of the organic growth of the economy, the direction of the economy, even before the policy discontinuity and some of the possible advantages that it will bring us that we were already on. And productivity is always probably the biggest dynamic in an economy. If you can become more productive, then companies can grow, they can return more profits to shareholders, et cetera. And it really ties together the economy and the investing dynamic in such a powerful way. And we have seen that the digitization of the economy has led to a renaissance in productivity that's even being accelerated now by the advent of artificial intelligence. And what we see is significant increases in productivity, the amount that companies are able to produce per worker, although there is always another side to this, which Luke might talk about, which is at the same time, there is the possibility of this having a negative impact on workers and ultimately consumers if that corporate productivity puts less pressure on companies to hire or to pay people. But at this stage in the economic cycle, we think it's a great driver of growth. Now, the other two things I wanted to mention, this is the second half of the question, is that the other two ladders that are directly attributable to the new administration that we're excited about are, number one, deregulation. And deregulation, we're already seeing the executive orders that are deregulating energy, and they'll flow through to other industries as well. And the opportunity potentially, particularly if interest rates move lower, to finance lots of corporate acquisitions, M&A activity, et cetera, which we haven't seen in many years, to act as a growth for economic activity and then ultimately market activity is very powerful. So that's one. And then the other one is, even this year, we could see some incentives for companies to double down, if you will, on their infrastructure as it relates to AI and other technology through the ability to potentially expense those costs, which is to say deduct it all in 1 year, which is something that was talked about in the campaign trail. And the best way to cut corporate taxes is to incent companies to invest by being able to deduct these costs and then return profits to shareholders through greater productivity. So tying it back into productivity, then just sort of cutting the corporate tax rate at the top level. So those are the sort of the things that we think are the most exciting ladders in the economy right now.
Right. So Luke, from an economic perspective, when you think about the ladders that Tony just spoke about, which ones are most influential in creating your baseline for the economy in 2025?
Yeah, certainly the baseline forecast is hinging most on that productivity. And what we're expecting this year actually is a slowdown. And it's already been mentioned that we do expect a slowdown in the economy from incredibly strong rates. So GDP growth, it wasn't surprising that we had GDP slow down or decline in 2020 and then bounce back so strongly in 2021. What has been surprising is that the U.S. economy, the exceptionalism being able to stay at basically 2.5% for the following 3 years. And even me, as I say that we're going to have a slower economy this year, it's like deja vu. A year ago, I thought that we would have slower growth. And like Meghan said, it continued to surprise to the upside, even above our exceptionalism expectations. But really what's driving that is we have had a slowdown in job growth. Tony's talking about how companies are getting more productive. They need less workers. We had a very strong jobs report just a couple of weeks ago, but we've seen a broader slowdown, 3-month, 6-month, 12-month basis. We've got that slowdown. We think that's going to slow consumer spending in our baseline forecast. And we've got wages slowing down so that we have GDP coming in at 1.8% this year. Now, that's not dire or terrible. It's just, a little bit below what we think of as normal growth rate of 2%. And we think that is solid, but we do have the ladders that Tony was just mentioning, and we just don't know which ones are going to come out of the administration. Like he was saying, you don't know what the now president compared to the candidate. And you also don't know which ones are going to get through Congress. It's a sort of an expensive thing to be delivering the tax cuts, and that goes into our Chutes sections. But we've got that anticipation of slower growth this year, which we do think is still supportive of markets. We have to see how some of those other things pan out.
Luke, your view is a little bit out of the consensus. And, from a Fed perspective, as well as an inflation perspective, can you just comment on where you stand relative to the consensus and share with our audience why?
Yes. So I think the GDP forecasts were a little bit below consensus, not too far off. Where we are more different is the inflation forecast, and then also what the Fed will end up doing in terms of rate cuts. So on the first question, we do expect inflation to come down and actually move below the Fed's target of 2% later on this year. Now, that's before considering any kind of tariffs and sort of the scale and what's going to go on there. We'll have to factor those in. But what we've seen is pretty significant slowing of inflation pressures, especially most consumer items, things that are traded, bought, purchased. We've seen goods prices come down, and consumers are not really putting businesses in a position where they need to push prices higher. There's not that much inflationary pressure, and we do expect that to keep coming down. We had a big change in the market Fed expectations back in December. The Fed doesn't think they'll be cutting as much. They're saying just 50 basis points. And we think double that, the 100 basis points of cuts, because if our inflation forecast plays out and you've got the unemployment rate already at a sort of a long-term equilibrium, we expect it to move a little bit higher, then there's no reason that the Fed should be keeping rates at this level. And I think as we get through especially the first half of the year, we'll see some of those expectations for the Fed change and come down more to 100 basis points of cuts this year.
Great. So, Tony, I like to stay on the ladder, but I just got stuck in a couple of chutes.
Uh-oh.
So we're going to turn to the shoot part of the game. But you and your team have highlighted basically three economic shoots: tariffs, immigration restrictions, and the U.S. debt trajectory. Starting with tariffs, many could say we've seen this movie before, and it's Trade War 2.0. Why is today different from the past, potentially?
Yeah, we don't know. And I would say that of all of the various sources of uncertainty, the outcome of the tariff narrative is the biggest one right now, because we have a spread, if you will, where on the one hand, tariffs could increase from 2% to 19% of total cost of imported goods. That is really unprecedented in modern times by a tremendous order of magnitude. And so we had effectively a president who used tariffs to great effect the first time around. And now he's doubling down on that and is talking even a much bigger game than what was enacted during his first administration. The fact that the tariffs, most of the tariffs on China, for example, were actually retained during the Biden administration, I think is evidence of the very significant degree of success that he was able to accomplish through tariffs, whether it be nearshoring, onshoring, so on and so forth. And in this particular environment, there are two levels to the tariffs. One are the economic dimensions, but then secondly, he is also trying to, and the administration is also trying to use tariffs to the effect for non-economic goals, whether it be, for example, the flow of fentanyl from China through Mexico to the U.S., which ultimately is an economic issue for us, of course. And so the tariffs themselves, nobody knows at this point to what degree, with the transactional president, if you will, they're leveraged, or to what degree they're actually part of the administration. And then the other element of this is that we come into this scenario after a period of unprecedented inflation. And while Luke will point out for us quite accurately many times that tariffs themselves are not structurally inflationary, which is to say, if you increase costs once, they're not going to lead to additional cost increases over time, because consumers have already suffered through so many cost increases. One more untoward jump in costs could actually produce a pretty significant inflationary effect on the part of consumers and cause consumers to pull back. And so in a way, the economy is even more sensitive to having a negative outcome from a Chutes standpoint if in fact the tariffs are larger than they might have been in the first administration. So we're really going to have to see, and this is the biggest part of uncertainty right now.
Well, I know, Luke, in my lifetime, probably one of the biggest issues that I believe has become a real political hot button is immigration. Can you just share a few comments on immigration policy and the impact that they may have on economic and monetary policy, and how it perhaps will influence inflation outlook?
Yes, absolutely. And as Tony was talking about the slew of executive orders that come on day one, as promised, a lot of them are about illegal immigration and trying to do something about the number that are in our country. And we think that that could end up affecting the labor force. And I should say that we're not taking a political view on any of this. It's just how it affects the economy and markets. When we look at the data, we know that immigrants have provided a huge source of our labor force growth, especially since the pandemic. So the chart that we use in the document and that we're showing here is showing that foreign-born members of the labor force, legal or illegal, provided about the same amount of growth each year in the labor force between the global financial crisis and then COVID. And then in the bounce back from COVID, we've had a huge contribution. And if we go back a couple of years to 2023, when we still had a strong economy, but inflation just kept moving down, a lot of that was because we finally had the amount of labor force participation that was needed for all the service companies that were ramping up. And a lot of that was native-born people returning to the labor force, but even more of it was from immigration, largely illegal immigration, undocumented workers. The construction industries, the leisure and hospitality industry, the agricultural industry rely heavily on those people. I'm not saying that's good, bad, or indifferent, but it's just a fact of the matter. And if one of the shoots that we identify is if the administration is successful in deporting large numbers of immigrants, then you need to make up that labor force from somewhere else. You either need to get it from your native labor force, and we don't see that we've got the number of people who are willing and able to move into the labor force to provide that kind of job growth and that increased labor force. And as optimistic as we are about artificial intelligence and CapEx, we don't think that it can come in and solve that problem immediately. So again, without taking a view on whether the policy is good, bad, or right or indifferent, if we have a very large deportation of people who are workers in the country, then it will have an impact on the economy and markets.
If I could just make one quick comment here. One of the things that I think has been really encouraging about the new administration and the president is that he does seem to be very open-minded, if you will, to input from the business community. And so there was a dynamic that occurred in the fall and into this year where some of the public dialogue between Elon Musk and himself around immigration involved Elon Musk talking about the benefits of the H-1 immigrants, the skilled immigrants, the educated immigrants, and then the president reacting to that. My take on it, at least, was that, hey, maybe we should actually increase that program, really double down on that. And so while we look at this primarily as a chute, maybe there's also an opportunity for it to be a ladder in the sense that we could, if the right policies are pursued, maybe even bring in more talent into the country legally.
Yeah, it's one just like with tariffs. And as Meghan describes in theme 3, there are a lot of good things that can come out of negotiations that are the result of using tariffs as leverage. And it's just so hard to see how it's going to pan out.
Mm-hmm. I think that dovetails perfectly into the third chute, which is really about the debt situation. And, on the campaign trail, there was a lot of promises that were made, and they could turn out to be a ladder, but they also could stretch an already precarious economy and have a negative effect. Tony, how are you evaluating these risks in light of the economic forecast?
Yeah, and this is Denise, the one that keeps me up at night, if you will, literally, actually, which is when you look at the amount of debt that we have and you look at the sensitivity of discretionary spending to the level of interest rates, what you see is that as interest rates potentially move higher, that even 100 basis point increase in interest rates over a long period of time has, in a sense, a devastating impact on the discretionary funds of the government, the ability to be stimulative when we need to, et cetera. And so we're now spending almost $1 trillion a year to service the debt at a 4% 10-year. If we get to a 5% 10-year, that number goes much higher. And to put that in perspective, that is slightly more than we spend on the entire defense budget. So the debt has become a real issue for us, and nobody knows the answer. When is it going to be too much? Mm-hmm. I think that Meghan's going to talk about this in a moment, I know, but I think that the behavior of the 10-year yield is both a barometer of how we're doing in the sense that it sort of tells us whether or not the market is comfortable with the amount of debt, prospectively, further debt we're going to take on, but it also acts as a regulator because if it moves too high, then it really causes the government to have to pull back at some point because they can't spend that much. Mm-hmm. So I don't want to take your thunder, but I know you're going to talk about that.
I think that's really where we're going with, our next question is really, Meghan, for you to give your feedback on the impact of interest rates on the market in terms of stocks and bonds and how this will influence where we believe, our trajectory will be this year.
Yeah, absolutely. And I think Tony just hit the nail on the head there. As I think about interest rates, you could almost think about 3 sort of transmission mechanisms. One is the cost of capital. Mm-hmm. This relates to businesses, small and large, needing to borrow, the ability to generate economic activity. We have seen in past years stress in the real estate market, and that has been managed, I think, very effectively by banks. But there is, a bit of a maturity wall coming, and I think there is an expectation that has been built into markets that rates will come down and this will all be managed effectively. If rates do not come down, I think you start to see some flare-ups of different pockets of stress again. The second transmission mechanism is what Tony was talking about in terms of the policy options. A lot of the enthusiasm in markets today relates to the pro-growth measures, stimulative measures, debt-driven measures that the Trump administration is talking about to generate growth. Those will be severely limited if we're talking about, in our view, a 10-year at or above, let's call it 5%. That's just a bit of a demarcation. And then the third area that we're watching carefully is the opportunity cost of equities versus bonds, because as interest rates move higher, it makes those safer assets, bonds, look more attractive. If you can generate 4 to 5% return with taking very little risk, what's the incentive to take on more risk in the equity market, especially at today's valuations, which is kind of the next piece of the puzzle where we are starting. The starting point of the market is very important for, this time of the year. And at this point in the new administration, we're looking at a price to earnings multiple of about 22 times forward earnings for the S&P 500, which is right around the highest levels that we saw in the post-pandemic run-up of the market, as well as, you have to go all the way back to basically the tech bubble to see valuations that high again. And there's not a perfect relationship, but there is a pretty decent inverse correlation between interest rates and valuations. And the higher interest rates climb, the more pressure it puts on valuations. And I just think this is also really important as we think about positioning in portfolios, because we do have ladders, but we also have chutes. And this reflects a lot of good news that's baked into the market and a very challenging sort of starting point in terms of delivering expectations above that, because really what drives equity market returns is either economic growth or profitability that comes in above what is expected. And this just really indicates to me that there's a pretty high bar for the market to clear at this point.
So Meghan, I'm sure. Okay.
I just wanted to add to that point, because when the rubber meets the road and you pull this all together and think about investing, we've never been in an environment like this where, as we look at the rate environment go up, we have so much federal debt. And it is such a constraining impact on the ability for the government to be stimulative, whether it be during a recession or even during a non-recessionary period, because we're running such large deficits as a percentage of GDP. When we think about how we're positioned in portfolios as a very rough shorthand, to the extent that the bond market, the 10-year, is somewhere between, let's say, 4 and 475 or 480, we're reasonably comfortable that, given our baseline economic forecast, the equity market is the right place to be. And you're always telling us that valuations are a lousy predictor of short-term behavior of the equity market. But as soon as that 10-year breaks through and gets closer to 5 or above, that's when we start to get really nervous and think about maybe pulling back.
Yeah, and Tony, that's exactly where I was going with Meghan. Based on all that we know, and I'm sure everyone in the audience wants to know, how should they be thinking about how they should be positioning their portfolios?
Yeah. So at the highest level today, we are entering the year with a modest overweight to equities, so a modest overweight to risk in portfolios. And really the view there is that we were actually just discussing this yesterday, that there's kind of some attractive optionality in the market today, notwithstanding the valuations and what's priced in terms of good news and how expensive equities are. Our view is very constructive for the markets. A GDP forecast that is just below, call it historical trend growth. A view that the Fed inflation is going to continue to come down, and the Fed is going to be in a position to cut rates significantly more than what is priced into the market today, we think is favorable, especially for U.S. equities, which is where we are focused in terms of our overweight. But even if we're wrong on that and inflation maybe takes a little bit longer to hit the Fed's target, and the Fed is a little bit more conservative in their judgment on cutting interest rates, I think it's because growth continues to deliver above expectations. And that's actually really good for equities and earnings. So we are looking at a pretty favorable backdrop. The one risk, which we put a pretty low probability on, is that stagflation scenario where inflation maybe reaccelerates and growth is very lackluster. That is a challenging environment for equities. But outside of that, I think we're well positioned with a modest overweight to equities. And even though U.S. large cap equities are expensive, there are still other opportunities out there. And the first one being a broadening of leadership. And this is something that we talked a lot about last year. It took a while to actually see it show up in the markets. And then actually the post-election rally reversed a lot of that. So we're kind of starting back from ground one. But we do think that a Fed that is cutting rates by 100 basis points this year, an economy that continues to expand gives opportunities for other non-tech related parts of the market. We still like tech, we still like AI. That's more of a secular growth structural position in the portfolio. But if you're looking at our Fed view, that would suggest that we're talking about a steeper yield curve, which is good for banks, materials, healthcare, which is expected to have better earnings this year compared to last year. So there's opportunities in some of those less loved, maybe a little bit more affordable parts of the market that haven't participated to quite the same degree. The other theme that we're looking at is a consumer that is slowing. And here, I think, this theme, as well as the one I just spoke about, really gives an opportunity for active management, which struggled last year. If you think about the concentration of the equity market leadership, we saw that the Mag 7 returned about 50% last year, double what the rest of the market did. Earnings growth was also incredibly robust for that part of the market. And it's a hefty weight in the index. So it makes it challenging for active managers to keep up in that market for the simplest reason being that they can't even own as much of the shares as a percentage of their portfolios as is the index, just because it's so top heavy. So I think a slowing consumer really talks about differentiation within sectors. It's not an all or nothing type of market. You're really going to be trying to pick those companies that still have brand power, still have earnings power, are still attracting consumer dollars when the consumer's being maybe a little bit more discerning in terms of how they're spending. The third theme, this is really interesting, and it gets back to AI. It's what we're calling AI stratification. So we've seen a lot of enthusiasm around the development of AI, really focused in kind of what we would call pure play chip stocks, to some degree, the infrastructure as well, utilities, all the energy that you need to make AI work. Utilities have had a great year in part because of that. But there's other levels of investment opportunity as it relates to AI really spreading out through the economy, generating that productivity that you heard Tony and Luke talking about. Software companies, we think there's an opportunity there, as well as the users of AI, which I don't think is priced into the market very much at all today, in part because it's really hard to know just how this will be monetized, just how this will be translated into the bottom line for companies. But if you think about opportunities for service companies, healthcare R&D, it requires a lot of really granular bottom-up research, which our teams do, our managers do, and we're very excited about that. But it's also probably something that will play out over multiple years and a little bit of a longer time horizon.
I just wanted to add to that point that the research is so important. Just as on the bond side, for example, credit research is really the sine qua non of of having a successful outcome. On the equity side, understanding within a particular sector which companies are, I won't single anybody out here today, but which companies are really going to effectively consume AI and use it for efficiency, for higher quality of client experience, versus those that are going to be the laggards. Those are really the distinctions we need to make in picking stocks today.
And it's not easy, because if you listen to earnings calls, every company throws out that they're using AI. And it's really about, okay, well, where's the meat there? How much does it actually add to productivity versus just sort of AI washing the earnings calls, if you will? So I think it does really require pen to paper and really doing some diligent research.
Yeah.
The last theme I'll just briefly touch on, we've already talked a lot about the whole idea of Chutes and Ladders is really about policy volatility and really trying to not only find the opportunities, but avoid the landmines, if you will, or those parts of the market that could get caught in the crosshairs. And this is not easy either. You might have one part of the market that is a beneficiary. Take technology companies, for example. They're a beneficiary of a lot of the AI investment that the Trump administration is very enthusiastic about, but they also generate significant earnings overseas. So tariffs and slower growth could hurt them, as well as higher interest rates because their valuations are more extended. So it's a multi-layered process to figuring out where are the opportunities and where we might want to be a little bit more cautious.
And listening to today's conversation, really to present it in the context of Chutes Ladders was really an effective and creative way to present the forecast. But if I'm the audience, there's been a lot that's already happened just in the last few days. So, Tony, maybe in real time, based on now we have President Trump, we've seen some of his policy decisions start to take shape already. Can you put all this into perspective in terms of how we should be thinking about the market real time?
Yeah. So I think there's two things the market's grappling with right now, and we're optimistic on both, which is why we're slightly overweight to risk, and we feel pretty good about the outlook for the year. So the first is this idea of the deficit. And it's very clear that inflation, interest rates, and the deficit are really the big governor over what's happening in the market. It's not about the outlook for growth. As Luke has said, or actually Meghan said, we have slightly below trend economic growth outlook, and we're actually a little bit below the market. So we feel pretty confident that growth is going to be good even without any additional economic ladders. But there is this idea that we're in a non-recessionary period or running 6 or 7% deficits as a percentage of GDP. How long can this go on? Whether or not the market will tolerate it. And inflation adds to that, because if we're wrong on inflation and inflation comes in hotter, that's going to put further upward pressure on rates. And rates are just so important in achieving this sort of finance-led animal spirits M&A activity that a lot of the market is hoping for and expecting almost in the Trump administration. So what you're seeing right now is we got the inflation report last week. The core CPI came in weaker than expected on the margin, and the market just took off, right? And it's because that outlook on inflation has such a powerful impact on rates. And that's just so important to ultimately even risk assets in the equity market, not just the bond market. So that's one thing that's happening. The other thing that's happening in the market, again, where we're also optimistic, is the markets are trying to figure out what this policy volatility, to Meghan's term, will mean for investors and for the economy. And I'll give you just one example of why I think there's real reason for optimism. The administration's very aware, on the one hand, that in a transactional environment, the president wants to be able to use tariffs and other potential sticks, if you will, in order to accomplish the long-term objectives of the country. But at the same time, the administration is very acutely aware of the risks that we've talked about, particularly as it relates to inflation and the size of the debt. I think that is what underwrote, to a large degree, the president's decision of the Treasury Secretary being a very serious guy and very focused on these issues. And then I also think that, for example, when you look at the tariff proposals, there's some rumors around exempting goods under $800. Well, why is that? That's because they don't want the tariffs to actually have this inflationary impact on the economy, potentially hold rates higher than they need to or should be. I think that all of this suggests that the administration is going to be developing these policies in a way that are going to be additive, not depletive, to overall economic activity and to productivity. And so we're very cautious, but which is why we only have a small overweight to risky assets. But we do have that overweight, and we do think it's will pay off over time this year. It has already. We're doing pretty well this year, so we'll see what happens. But we think
stay positive.
Yeah, stay positive.
Well, I thank you all, and I want to thank all of you, our guests, for joining us today, and really hope that you found the insights that were shared by Tony, Meghan, and Luke very insightful as you game out your portfolios in 2025. And if nothing else, I just want to wish everyone a very happy 2025. And on behalf of Wilmington Trust, we thank you for your participation today. Have a great rest of the day.
This podcast is for educational purposes only and is not intended as an offer or solicitation for the sale of any financial product or service or recommendation or determination that any investment strategy is suitable for a specific investor. Investors should seek financial advice regarding the suitability of any investment strategy based on the investor's objectives, financial situation, and particular needs. The information on Wilmington Trust's capital considerations with Tony Roth has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. The opinions, estimates, and projections constitute the judgment of Wilmington Trust as of the date of this podcast and are subject to change without notice. The opinions of any guest on the Capital Considerations podcast who are not employed by Wilmington Trust or M&T Bank are their own and do not necessarily represent those of M&T Bank Corporate or any of its affiliates. Wilmington Trust is not authorized to and does not provide legal or tax advice. Our advice and recommendations provided to you is illustrative only and subject to the opinions and advice of your own attorney, tax advisor, or other professional advisor. Diversification does not ensure a profit or guarantee against a loss. There is no assurance that any investment strategy will be successful. Past performance cannot guarantee future results. Investing involves a risk, and you may incur a profit or a loss. Any reference to company names mentioned in the podcast should not be construed as investment advice or investment recommendations of those companies. Third-party trademarks and brands are the property of their respective owners. Third parties referenced herein are independent companies and are not affiliated with M&T Bank or Wilmington Trust. Listing them does not suggest a recommendation or endorsement by Wilmington Trust. Private market investments are only available to investors that meet the U.S. Securities and Exchange Commission's definition of qualified purchaser and accredited investor. Facts and views presented in this report have not been reviewed by and may not reflect information known to professionals in other business areas of Wilmington Trust or M&T Bank, and may provide or seek to provide financial services to entities referred to in this report. M&T Bank and Wilmington Trust have established information barriers between their various business groups. As a result, M&T Bank and Wilmington Trust do not disclose certain client relationships or compensation received from such entities in their reports. Investment products are not insured by the FDIC or any other governmental agency, are not deposits of or other obligations of or guaranteed by Wilmington Trust, M&T Bank, or any other bank or entity, and are subject to risks including a possible loss of the principal amount invested. Wilmington Trust is a registered service mark used in connection with various fiduciary and non-fiduciary services offered by certain subsidiaries of M&T Bank Corporation, including, but not limited to, Manufacturers and Traders Trust Company, M&T Bank, Wilmington Trust Company, WTC, operating in Delaware only, Wilmington Trust N.A., WTNA, Wilmington Trust Investment Advisors, Inc., WTIA, Wilmington Funds Management Corporation, WFMC, Wilmington Trust Asset Management, LLC, WTAM, and Wilmington Trust Investment Management, LLC, WTIM. Such services include trustee, custodial, agency, investment management, and other services. International corporate and institutional services are offered through M&T Bank Corporation's international subsidiaries. Loans, credit cards, retail and business deposits, and other business and personal banking services and products are offered by M&T Bank, member FDIC. Copyright 2025, M&T Bank and its affiliates and subsidiaries. All rights reserved.